the Morning Blast with myself and Mr. Michael Brown. There he is. Let's add him in. Co-host. Whilst he's joining, I will quickly do the legals because I'm trusted with that these days. Nothing discussed on this space session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited, Traders PIQ or PIQ Suite, or indeed the hosts, which, as you know by now, is Mr. Michael Brown, way, and Mr. Ryan Paisley, way. Hello.
Good morning.
Good morning. How are you?
I'm very well. Just bear with me a moment while I move away from a violinist who's decided to rock up outside the office this morning.
Well, as you do. Bit busking.
Well, yeah, quite. Although it's a little bit odd because he's not actually playing it. He's just got a speaker which is playing violin music, and then he's just sort of waving his arms around.
Oh, okay. See, and old Ryan would be making a savage joke right now about maybe like rusty trombones or pink oboes, but yeah, I'm way above that now. So.
Oh no.
Yeah. Starting strong.
Oh dear.
Quick, move on. What's happened?
Right. Have you done your disclaimer?
I have, mate. I have. I'm getting better at this.
Oh, good. Very good. Right. Good morning. Indeed. Good morning, everyone. Plenty for us to get through this morning because it was a very, very busy day indeed for the financial markets yesterday. Obviously, plenty of catalysts, although it is worth noting that despite all of those catalysts, markets didn't really go anywhere. The S&P closing lower by around about 0.5%. Treasuries encountering some very modest selling pressure led by the front end of the curve, with 2-year yields rising by around 3 basis points on the day. The dollar spending much of yesterday treading water around the 108 figure, and gold and crude also not doing much of particular excitement. In terms of those events from yesterday then, obviously we had 3 policy decisions from G10 central banks. The Riksbank in Sweden holding cutting the policy rate, by 25 basis points to 2.25%, although revising their guidance to note that policy going forwards will be guided by, and I quote here, a tentative approach, perhaps signalling that further rate cuts beyond yesterday's move are unlikely. We also heard from the Bank of Canada yesterday, who delivered a 25 basis point cut of their own, lowering rates to 3%. They did, though, remove their prior guidance, which was alluding to the likelihood of further rate cuts, and this was due to, of course, the imminent threat of tariffs being imposed by the United States. President Trump, of course, has mooted the 1st of February as the potential date for those tariffs to be imposed. The BOC also brought to an end their balance sheet runoff process. They are going to resume asset purchases in March, but before anyone gets excited about this being quantitative easing, it's not. It's just so that the BOC can maintain the size of their balance sheet. If a central bank is holding a load of bonds, those bonds, by the very nature of the product, mature at some point in the future. If you do not do asset purchases as those bonds mature, the size of your balance sheet will shrink. All they are doing is buying those new securities in order to ensure that the balance sheet remains at the same size. It is not by any means a monetary a measure to sort of stimulate the economy or deliver any sort of monetary easing. So don't get that one wrong. Of course, though, the main event yesterday in the policy world was the FOMC decision, the first decision of the year from the FOMC. The target range for the Fed funds rate held steady at 4.25% to 4.5%, bang in line with expectations and also bang in line with what markets have been pricing before the announcement. The vote to hold rates steady was a unanimous one, and the policy statement was broadly unchanged from that delivered after the December meeting. The only notable changes were that the Fed now describe unemployment as having stabilized at a low level, and that while inflation remains somewhat elevated, the statement did remove reference to inflation having made progress towards 2%. Importantly, though, this is not intended to send any sort of policy signal. As Powell noted in the post-meeting press conference, this is effectively just the committee tidying up their language around how they're describing the economy.
Grammarly.
This is something that
It
is...
was Grammarly.
Well, exactly.
Grammarly rocked markets, as I said yesterday. Everyone got
exactly.
like, no, it was just the autocorrect.
It's actually not uncommon if you're sad enough to go back and look at how the January Fed statement compares to the December Fed statement over the years. They do often just kind of tidy up their economic assessment a little bit. So certainly no policy signal in that. Although, as Ryan, you rightly said, we did see a modestly hawkish move on the back of that statement before that was then paired upon the clarification received during the press conference. The press conference itself was a little bit of a non-event, to be completely honest with you. It's very clear that the Fed and Chair Powell are trying to build as much optionality into the policy outlook as possible, and that's not really surprising given the huge degree of uncertainty that there is on the outlook, not only in terms of what may come from the White House on the fiscal policy side of things, but also in terms of how the continued resilience in the labour market may affect disinflationary progress as we move through 2025. In terms of the Q&A and the press conference, as I said, there weren't really that many notable lines in there. Powell did, though, note that policy remains restrictive, although meaningfully less restrictive than before cuts begun. Powell also noted that the Fed remain above the estimates of the longer run neutral rate, and not just above, but meaningfully above. The implication of that, of course, if you assume that the Fed are looking to get the Fed funds rate back to neutral this cycle, which is a logical assumption, the implication of them being meaningfully above that level is that there could be significant, or there is significant room to deliver further rate cuts, just that the timing of those rate cuts will depend on incoming economic data. And again, Powell saying that the reaction function from the Fed is unchanged from where it was last year. They want to see progress on inflation or labour market weakness in order to deliver a cut. If they don't see either of those things, they will stay on the sidelines. Powell didn't really make much comment in terms of Trump. He has had no contact with the president so far. He was also saying that the Fed will take a wait and see approach in terms of responding to the policies that the Trump administration may implement. Speaking of which, moving on to some news from yesterday. If Tom Talks Cars is on the call, one for him. The Trump administration, they are reportedly discussing tightening curbs on NVIDIA chip sales to China. Apparently, officials within the administration have held discussions about restricting sales of NVIDIA's H20 chip to China. God knows what that is, but I would assume this is partly, at least, in response to the shenanigans going on with DeepSeek and the potential for US tech to be used for, models and various AI bits and bobs. The other thing, moving swiftly on from that.
Straws there, didn't you?
Yeah, I really was. The other thing that Trump,
he's drowning.
the other thing that Trump did yesterday is that his media group, which obviously runs Truth Social, they are apparently wanting to expand into financial services via a partnership with Charles Schwab. What the hell could possibly go wrong with that one? Other bits and bobs from yesterday.
I just say friends. Charles Schwab are friends of PIQ, so it's the oh my god bit was directed at Truth Social and Trump, not so much.
Yes, yeah. Let me stress that one as well. I've got no doubt in Schwab. They're a very reputable firm. It's more the other lot.
The best.
Indeed. We did have earnings out yesterday from three of the Magnificent Seven tech stocks. Not all just tech, actually. Starting with Tesla, they delivered top and bottom line. They delivered a top line beat, but a bottom line miss. They were initially about 5% lower after hours yesterday. They did recover some ground into the close as we moved through the earnings call. We also heard from Microsoft yesterday. EPS and revenues broadly in line, but the cloud revenue line was considerably softer at 25.5 billion. The consensus was at 25.9. Microsoft were down by about 5% in the post market yesterday. And then on to Meta. Firstly, if anyone from Meta Investor Relations is listening, what the fuck were you doing last night? The earnings were 45 minutes. Well, the earnings were 45 minutes late, which made a long day on the desk even longer. Although I guess for Meta investors, the earnings were worth waiting for because they delivered a substantial beat on earnings per share, $8.02 compared to the $6.78 consensus. Revenues were also.
I don't know if I've mentioned this, but a cracking trading shop that provides proper 24/5 trading on these stocks. Better hours than you get most places. It's a firm called Pepperstone. Absolutely
Who are
top
they?
drawer outfit they are. Check them out. They're very good friends of PIQ. Check them out. Give them a look, especially if you want kind of exposure to these tech names, because I'm not making this up. Genuinely, surprisingly few shops open up 24-hour trading quite like they do. There you go. That is a shameless plug. Make sure Lawrence gets hold of that one.
I will. Just going back to Meta for a second, despite those solid figures, they did deliver somewhat soft guidance, seeing Q1 revenue between 39.5 and 41.8 billion. That was well below the midpoint estimate of 41.7 billion. Their shares were initially lower by about 4% on those earnings. And to be honest, I've got no idea what happened to them during the call because I fell asleep. Last but by no means, it's been a long day. I was in bed as soon as those earnings crossed. My Bloomberg was shut.
Cup of cocoa.
I didn't even have time for that. Last but by no means least, yesterday we did have this. Well, I was going to say eagerly anticipated, but I'm not sure it was. But this speech on economic growth from the Chancellor, Rachel Reeves. She was. I saw a tweet from Sky News' economics editor, Ed Conway. Rachel Reeves used the word growth 8 times in the first 2 minutes of that speech. You're going to need more than just saying the word to engineer growth within the UK economy. It's ridiculous. The long and the short of it was that there were no surprises in this speech. Reeves was talking about delivering more in terms of offshore wind. Obviously, the government wants to get this net zero thing by 2030. Great, very noble aim. 16 gigawatts of extra offshore wind power. Brilliant. What the hell are you going to do when there's no wind? Are we all just going to work by candlelight and typewriter? I'm not sure. Reeves was also saying that she will.
I thought that's how you write your reports, to be honest, with a monocle and
I've got a quill and ink. Reeves was also saying that the government will fund an east-west rail project. This is basically building a railway line between Oxford and Cambridge, trying to turn that into a sort of biotech centre. They're doing a whole lot of infra work around Manchester as well. And Rachel Reeves also confirmed that government will give their approval for a 3rd runway at Heathrow. She has said this morning on the news that planes will take off from that runway within 10 years. So that is the end of Jan 2035, which is plainly not going to happen, to be completely honest with you.
Just on that, sorry, just quickly on this. So she was asked why, obviously, she's so in favour of 3rd runway now, but she was asked why previously she was so adamantly against the expansion of the Leeds Bradford Airport.
Oh, yes.
And her reasons were, well, no one was flying during COVID.
Oh.
I'm like, so if that's how short-sighted you are, go give your head a wobble.
Yeah.
It's just ridiculous. It just, look, I get people are allowed to change their minds. Politicians changing their minds is a very good thing, because it means they can adapt into the new data and the new information and whatever the world changes. But this is a whole, she blatantly hasn't got the logical kind of power to kind of think ahead if that was her default position. She's now just clutching at anything she can do. Don't get me wrong, I'm in favour of expanding airports. I wish they would build a significant airport out in the east of England, out in Kent, because I think that'd be very, very productive. But I just mean, what is she doing? It's like she is completely inept at what she's doing. It's just so frustrating. Get me out of here.
The other point I would say on that is this is all well and good, and I agree. We do need much better infrastructure in the UK. 2 points. One is that Rachel Reeves has managed to annoy anyone who lives north of Manchester because there isn't any infra projects that have been announced.
I'm south of Manchester, and I'm pretty annoyed.
Well, exactly. The other thing is this is all well and good, but these projects are going to take a hell of a long time, and we need economic growth now. The problem is not how the economy is going to grow in 2030 or 2040. The reason why the government are at risk of breaching their own fiscal rules is because the economy is doing nothing and stagnating right at this moment in time.
But is it, a spade won't hit the ground. A spade won't hit the ground for 5 years.
Oh no,
You know
absolutely
what I mean?
not. And certainly with the Heathrow thing, you've even, and I don't want to turn this into a political rant, but you've even got the mayor of London, Sadiq Khan, saying that he's going to use
Yeah.
everything in his power to block an expansion of an airport, which would give a huge boost to the economy of his city. So yeah, that gives you an
Oh,
idea
led by
of
donkeys.
how
Led by
terrible
donkeys.
this whole thing could go. But anyway, let's not go down that route because
Anyway,
I could
yeah.
rant about him all day.
Go on. Cool. Is that you done for that part?
It is for now. Yes, sorry.
Oh, cool. Sorry. So quite a slimline one today because our friend Zach, who normally does the overnight news roundup, is out in Thailand traveling between places. Apparently, I'll leave that up to your judgment. What I think he's really doing.
Mm.
Anyway, so thankfully, our other friend Andrew Hart, who puts out a lovely morning note each day, which has got some really great insight on it. His email dropped in my inbox, so I've taken some stuff off of him. So we'll start up with the unfortunate news. Well, sorry, the horrible news. The many feared dead after a passenger jet and helicopter collided in the Washington's Potomac River. Scores of people were feared dead after an American Airlines regional passenger jet and a U.S. Army Black Hawk helicopter collided and crashed into the frigid Potomac River near Reagan Washington International Airport on Wednesday night. Just on that, I've just seen whilst Michael was talking that Trump is come out very clearly blaming the helicopter pilots on this. So we'll see how this materializes. Moving away from that, France's economy retreated slightly in the fourth quarter as Paris 2024 Olympic Games effects waned. That's according to their statistics agency. It is a quarterly gross. That's the INSEE report. So one to keep an eye on. And funny enough, Michael, I do believe we mentioned this during the Olympics. We did say
I
that,
think
yeah,
we
they're
did.
going to get a boost after it, but then it's going to fade away pretty sharpish. So interesting to see. And also bear in mind that the French government are pretty much non-functional at the moment as well. So interesting to see if they need to try and get anything going, especially with the budget issues they've got. In geopolitical area, security agents escorted the Inspector General of the USDA, so the US Department of Agriculture, out of her office on Monday after she refused to comply with her firing by Trump administration. That's according to sources familiar with the matter. Basically, they had to drag her out kicking and screaming. I do wonder if she took a shit in the desk because that's what normally people do when they're a bit disgruntled. That's what I do. In equity space, free from equity, obviously Michael covered the earnings last night. A couple of ones that he's not mentioned. Deutsche Bank on Thursday posted a bigger than expected drop in fourth quarter and 2024 full-year profits as legal provisions and restructuring costs eroded revenue gains at its global investment banking division. And what Shell reported a smaller fourth quarter profit on Thursday as the oil major took a hit from lower refining margins and lower liquefied natural gas trading, and said it would buy back $3.3 billion worth of shares. They love a buyback. And in Germany, concerns are growing among Volkswagen's board members that sweeping cuts agreed with unions last year will not be enough to turn around the struggling car maker's core brand. That is something as well we mentioned, that there will be more of this to come, and it looks like it's materializing. And just for those that may have not listened yesterday, it's been reported increasingly so that some Chinese automakers are circling Volkswagen plants and kind of manufacturing operations to pick them up at some cheap prices and start building Chinese cars in Germany, which obviously, as I think we can all imagine, that will go down like a shit balloon with German policymakers. Back to you in the studio.
Oh, that's all from you, is it this morning? Right.
Yeah, well, yeah, because Zach's fucked off, so I'm bare bones here.
Oh dear. Well, let's hope Zach has finished doing whatever nefarious acts he may be up to do.
Moving on.
Yeah, exactly. Right. In terms of today, then, another busy docket ahead. Actually, at 10 o'clock this morning, we have the latest GDP figures out of the Eurozone. The economy expected to have grown by 0.1% on a quarter-on-quarter basis in the final 3 months of 2024. Quite a steep slowdown from the 0.4% pace that we saw in the third quarter of last year. Also at 10, we have the latest unemployment data out of the Eurozone, with headline unemployment set to have held steady at 6.3% in December. In terms of other data releases, I'll get on to the ECB in a moment. Out of the States this afternoon, we do have the weekly jobless claims numbers. Continuing claims, they are expected to tick higher to 1.9 million from a prior 1.899 million. So not the biggest rise, but nonetheless, that data does coincide with the survey week for the January non-farm payrolls print. And of course, that number is due next Friday, the 7th of February. Also out of the States at 1:30 this afternoon, we have the first read on fourth quarter GDP, with the economy having expected to have expanded by 2.7% on an annualized quarter-on-quarter basis in the final quarter of 2024, and that would be a modest slowdown from the 3.1% pace that we saw in Q3. The US also brings us pending home sales data this afternoon as well. On the policy front, of course, today is ECB Day, the first ECB decision of the year, due at 1:15 London time this afternoon, with President Lagarde's press conference following around half an hour later. Fully expecting the deposit rate to be cut by 25 basis points to 2.75%. That will be the ECB's fifth rate cut of the cycle and fourth rate cut in a row. Money markets fully pricing a 25 basis point cut today, and also another 25 basis point cut at the next meeting in March. In terms of the guidance, the ECB will likely reiterate that they are going to take a data-dependent and meeting-by-meeting approach to future policy decisions, while refusing to pre-commit to a particular policy path. President Lagarde will likely stick to that script at the post-meeting press conference, while also indicating that further cuts are likely to be required, while again flagging uncertainties around the outlook primarily associated with trade, although risks to growth in the Eurozone are likely to remain tilted to the downside. Key questions for market participants over the ECB decision today. Firstly, will be whether or not a 50 basis point cut is discussed at today's meeting. Of course, such a move was discussed but decided against in December, so we will see whether policymakers discussed a larger move once more today. Secondly, what was the degree of unanimity around the policy decision? Pretty much everyone on the governing council, apart from the Austrian representative Robert Holzmann, have indicated in speeches that they are comfortable with the idea of a 25 basis point cut this time around. Of course, the other question is, are there any of the doves pushing for more rapid rate reductions? And thirdly, the question of where neutral lies within the Eurozone and whether the ECB will likely go below neutral this cycle. Most economists see the neutral rate in the Eurozone as being somewhere between 2 and 2.5%. If you assume that the ECB deliver a cut today and a cut in March, that would leave them at the top end of that neutral rate by the end of Q1. So I think attention will increasingly focus on whether the ECB are going to take rates into outright easy territory, although don't expect any sort of firm answer from Lagarde today. As is always the case for the ECB, it's not only the statement and the press conference that are worth paying attention to, but also the potential for sources stories, which may drop at really any point throughout the afternoon, which will provide additional colour and clarity on what policymakers discussed today. Besides that, it is another relatively busy slate of earnings today. Before the market open, we hear from MasterCard, and we also hear from UPS, so we will see whether they can deliver. And then after the market close...
Oh,
Sorry. After the market close, we hear from Visa. We also hear from Intel, and last but by no means least, we also hear from Apple as well. They report at 9:30 this evening London time, 4:30 on the east coast of the United States. The implied move in Apple stock over earnings is about 4% to either the up or the downside, and I think participants will focus primarily on how ongoing demand, well, the lack of demand in China is impacting Apple's sales, and also how Apple plan to turn around their struggling AI business. They brought in someone new to head that up recently, and clearly they are not making as much progress on that front as their competitors, so that will also be in sharp focus among market participants as well. And that is your lot from me this morning.
Could I just say I'm slightly disappointed because I did make a note before the show and I even timestamped it because I was confident you were going to make a pun about the Swatch earnings. I thought something watch clock ticking, so I thought they was just ripe for a pun and you let me down.
Well, no,
I'll try and guess.
I'll be honest, I have been a little bit slacking. I haven't actually looked particularly closely at some of these European earnings this morning, so that would be why there wasn't a pun, because I didn't know they'd come out.
Well, Well, I'll attempt to guess tomorrow's pun ahead of time with a timestamp. I'll get it right one day. But anyway, Mr. Michael Brown, thank you so much as always. You are the hostess with the mostess. Guys, listeners, thank you as always for listening in, especially our regular listeners. We really do appreciate you and the feedback you provide. And if you are training today, keep it tight, and we'll see you tomorrow. Take care. Much love.
Bye bye.
Bye bye.